Amazon is up 12% before the bell, Apple is down more than 7, and the difference between those two numbers is the whole AI trade in one morning. Good morning, it's Friday, July 31st. I'm Nid Fertucci with Eleanor Whitfield and Marcus Brooks, and today we've pulled Sarah Mitchell into the fourth chair because between an overnight Iran de-escalation, a brand new Trump tariff blitz, and Exxon and Chevron both reporting before the bell, the oil story is too big to leave to a guest spot later in the show.
Morning, Nick. Morning, Sarah.
Morning all. Big show.
Good to be back. Bring your coffee. This one's got a lot of moving parts.
It really does. Amazon and Apple closing out the week's hyperscaler earnings, a chip complex trying to rally for a second straight day, the Bank of Japan, Michigan Sentiment, and Exxon and Chevron both reporting what could be their best quarter in 15. We'll get to all of it. But first, the board. Both of yesterday's closing calls already resolved, and they both came in wins. Marcus, yours first. Amazon.
I said if ASM growth cleared 31% and the stock held up or rallied despite a bigger capex guide, that's a third hyperscaler in 1 week, proving the market rewards cash-generative capex. ASM did 37%. The stock's not just holding up, it's up 12% pre-market. That's about as clean a win as I've had all quarter.
Eleanor, yours was the bond market.
Mine was, I said if the 10-year closed Thursday above 4.7%, that's confirmation the hawkish repricing is sticking. Below it, I said some of Wednesday's shock fades. It closed at 466. And the shock did fade. The S&P put up its best day in weeks. The VIX fell 16%. I'll take that one too.
2 for 2, panels on a roll. Scoreboard update, Eleanor moves to 9 wins, 5 losses, streak of +4. Marcus, 7 and 9, streak +2. Sarah, you still at 0 and 1 from your last time in this chair? No call in the mix yesterday since you weren't here. Dave still 0 and 2, sitting out again today.
0 and 1 follows me around. I'll fix that before we're done today.
Bold talk for someone who hasn't made the call yet.
Passions.
Let's get into it. Amazon and Apple, minutes apart last night, closing out a week where every hyperscaler got graded on the same test. Does the AI spending convert or doesn't it?
And Amazon passed about as clearly as Microsoft did 2 nights earlier. Revenue of $200.6 billion, up 20% year over year, the company's first ever $200 billion quarter, well ahead of guidance. Earnings of $5.75 a share against an estimate of $1.82. But the number that matters is Asu Zumpy, cloud revenue up 37% to $42.2 billion, the fastest pace in more than 4 years, pushing the annualized run rate to $169 billion.
And it's not just growing, it's carrying the company. AWS is something like 60% of total operating income now. Advertising's up 26% too. This was about as complete a print as you'll see from a company this size.
So that's Microsoft and now Amazon both converting. Apple's the opposite story overnight.
Apple actually beat on both lines, EPS of 202 against an estimate of 189, revenue of $109.4 billion, iPhone revenue up 22%. On the headline, that's a good quarter.
It's the guidance that's doing the damage. Apple's guiding the current quarter light and management's pointing at supply constraints, a memory price surge, and chip shortages eating into what they can actually ship. Add in services and Greater China both landing short of estimates, and you've got a stock that fell about 3% after hours on the print itself and then kept sliding. It's down more than 7% pre-market now.
Give me the mechanism. How does a memory price surge hit Apple specifically?
Apple doesn't make its own memory chips. It buys them, same as everyone else building phones, laptops, servers. If the AI build-out is soaking up global DRAM and NAND supply, and Microsoft and Amazon both just told you they're spending more to lock down exactly that, the input costs for anyone downstream go up, and availability gets tighter. Apple's now competing with its own cloud computing customers for the same chips.
So the same AI capex that made Amazon's quarter is squeezing Apple's next one.
That's exactly the read-through. It's one supply chain, and right now it only has room for one winner's narrative per product cycle.
I push on squeezing a little. Apple guided conservative, and Apple guiding conservative into a supply constraint they can probably work through by the holiday cycle is a very different problem than Meta's. Meta's issue was margin compression from its own spending choices. Apple's issues sourcing. Sourcing problems get solved with time and money, and Apple has both.
So who actually walks away from this week having proven the most out of Microsoft, Amazon, and Apple?
Amazon, for my money. Microsoft had one great division. Amazon just showed cloud, advertising, and retail all working in the same quarter at scale, on top of a $200 billion top line.
I'd still put Microsoft first on capital efficiency. Azure's margins are cleaner, but I'm not going to argue hard against Amazon's print. It was genuinely broad. Where I'd actually put the emphasis is Apple, because a supply-constrained guide from the biggest hardware company in the world tells you the AI infrastructure build-out has started hitting the physical world in ways that show up in real product guidance, not just CapEx slide decks.
Right. This stopped being an abstract spending versus revenue story about 3 weeks ago. Before we leave earnings night, quick round on who else reported, because there's a pattern buried in the also-drans.
There is, and it's a clean one. Reddit beat. Revenue whopped 61%, daily active users up 18%, and still fell 7 to 10% on worries about search referral traffic drying up from Google. Roblox guided third-quarter bookings well short of consensus and dropped about 13%. Coinbase posted a third straight quarterly loss, missed on both lines, and fell about 5%.
So 3 application layer names, 3 earnings beats or near beats on the surface, 3 stocks getting sold anyway.
Why? Give me the thread connecting Reddit, Roblox, and Coinbase to what we just said about Apple.
Same mechanism, different layer. Infrastructure. AWS Azure is getting rewarded on backward-looking numbers because the demand is visibly real and locked in via contracted backlog. Everything one layer up, closer to the actual consumer or trader, is getting priced on the forward guide, and forward guides this earnings season keep coming in cautious. Strong headline, soft guidance, sold. That's now a pattern, not a one-off.
I'd add that's actually a healthy market behavior, even if it doesn't feel like it watching the tape. Investors aren't just buying beat, they're pricing every forward data point inside the print now. That's discipline, not panic.
So the lesson from last night in one sentence?
If your growth is contracted and backward-looking, you got paid. If it's a promise about next quarter, you got picked apart on the fine print, no matter how good the headline number was.
Let's move to the chip complex, because that's where this physical constraint story is actually trading in real time, and it's also where you two left something unresolved.
We did, and we should revisit it fairly. My case Wednesday was that the semiconductor route was spreading, not rotating. SMH down 4 straight sessions, Korea getting hit even harder. My level was needing to see SMH extend the slide into a 5th or 6th red day for that case to hold.
And my level was the new high, new low ratio staying above 2 to 1. So Thursday, chips ripped, Intel up over 11%, Nvidia up 2 2/3, the whole complex riding Microsoft's Azure number higher. And this morning it's extending again. The semiconductor ETF SOXX up another 3% pre-market, Micron up 3.5%, Intel up 4.6%, AMD up 3%, even Nvidia's adding another point. That's 2 green sessions in a row after 4 red ones.
So, Eleanor, does that break your case by your own rule?
By my own rule, yes. 1 green close was supposed to break it, and we've now had 2. I'll take that loss on the letter of it. But I want to add the number that's keeping me from fully conceding the spirit of it. SMH is still down 9.5% over the past month. This complex is on pace for its worst month since 2002, even after 2 good days. A 2-day bounce inside a historically ugly month isn't the same claim as the rout is over.
That's fair, and honestly, it's the more interesting number in the segment, but I'd frame it as exactly what a rotation looks like from the inside. It doesn't feel healthy while it's happening, it just eventually shows up as a good month-over-month chart. The driver here is concrete too, not just sentiment. Amazon and Microsoft are both raising CapEx specifically to lock in memory supply, and Korea Samsung, SK Hynix is having its own sharp rebound alongside it. That's demand data, not just relief buying.
So where do you two actually land now? Closer together or still split?
Closer, honestly. I'll concede the daily trend. I'm just not ready to call the month healed.
I'll take that. Split the difference, trend's mine, framing's hers.
I like an argument that actually moves instead of just restating itself twice. Let's turn to the story. I think is going to matter more than any single earnings print by the end of today, the new tariff blitz, because this one you two are not going to agree on, and I don't think we should force it.
We're not going to, and I'll go first. Overnight, the administration launched tariffs on 60 trading partners, the European Union, China, the UK, Canada among them, 10 to 12.5%, effective 12:01 this morning. My concern is straightforward. Tariffs are a direct input cost shock. They show up in the same inflation data the Fed is already parsing after Wednesday's hawkish dissents. We just spent all of yesterday's show on a Fed that has 3 members ready to hike. Layering a fresh tariff wave with 3 votes already nervous about inflation is not a neutral combination.
I actually think the market's reading it differently than that, at least so far. Futures are up across the board this morning, S&P futures adding about 0.6%, Nasdaq futures over 1%, and that's with the tariff news already out. If this were purely an inflation shock story, futures wouldn't be green into a morning with 60 new tariffs on the board. I think the market's pricing this partly as negotiating leverage, the same pattern we've seen with prior tariff waves, where a chunk gets rolled back or exempted within weeks.
I'd push back on reading calm futures as the final verdict. Futures this morning are mostly reacting to Amazon's number, not doing a clean read on trade policy. Tariff inflation shows up with a lag in the data a month or two out, not in tomorrow's open.
Give me the tiebreak. Then, what actually resolves this one for the listener?
Watch core PCE and CPI over the next 2 prints. If tariff-exposed categories, goods prices specifically, start accelerating in August and September data, that's my case, and it hands the Fed's hawks more ammunition right when they've already got 3 votes.
And mine is simpler. Watch whether any of these 60 partners get exemptions or rollbacks inside 30 days. If negotiations start peeling categories off the list quickly, that's the leverage play pattern again, and the inflation math never fully materializes.
Play devil's advocate with yourself for a second. Marcus, what's the version of this where you're wrong fastest?
Honestly, if a major partner retaliates instead of negotiating, the leverage red only holds if the other side treats this as an opening offer. China matching with its own tariffs instead of coming to the table breaks my case in about a week, not 30 days.
And mine breaks fastest if August core PCE actually comes in soft goods categories. Cooling instead of accelerating would tell me the tariff pass-through is slower or smaller than I'm assuming, and I'd rather say that now than pretend the case is airtight.
So, Eleanor's watching the inflation data in 6 to 8 weeks. Marcus is watching the negotiating table in the next 30 days. And you've both just told me exactly what would prove yourselves wrong. That's the honest version of this argument. Sarah, your beat is exactly where trade policy and this week's other big story collide. Bring us into oil.
Happy to, because it's been a wild 48 hours even before the tariffs landed. Wednesday, Iran fired on U.S. forces, all intercepted, and the U.S. and Saudi Arabia struck back at Iran-aligned targets in Iraq. Overnight into Thursday, Iran's Revolutionary Guard hit 3 tankers in the Strait of Hormuz, and Central Command answered with what they're calling a powerful response. Brent spiked above $93 on that escalation.
And this morning?
This morning, it's unwinding. WTI's down 1.6% to 82.27, Brent's off 1.4 to 87.78. The reason's simple, and it's the number I'd actually anchor on. Shipping data shows traffic through the strait has recovered to roughly 30 to 35% of pre-war levels. That's still depressed, but it's moving the right direction, and tanker flows recovering is a faster, more honest signal than any statement out of Washington or Tehran.
Faster than statements. I like that framing. Numbers on the water don't have a press office.
Exactly. Rigs and tankers don't lie the way officials sometimes do.
So walk me through what today's tariff blitz does to that picture, since Eleanor and Marcus just spent 5 minutes disagreeing about it.
It complicates it, honestly, more than either side of that argument fully captured. Tariffs on 60 partners raises shipping and input costs industry-wide, on top of a region that's still only 2/3 recovered on tanker traffic. If Hormuz flow stalls again, and it stalled twice already this month, you'd be stacking a tariff-driven cost shock on top of a fresh oil-driven one. That's the scenario that actually validates Eleanor's inflation worry fastest.
Thank you, I'll take the assist.
Ganging up on me already, and we're only 12 minutes in.
Give a listener a level on oil specifically, not just the geopolitics. Where does this get interesting again?
$90 Brent is my number. We spiked through 93 on the strikes and we're back under 88 now. If tanker traffic keeps recovering and we hold under 90 through next week, this was a shock, not a regime change. If we're back above 90 on fresh Hormuz disruption, this whole de-escalation framing was premature. And Eleanor's inflation taste gets a lot more concrete, a lot faster than the tariff data alone would give her.
And that's happening the same morning two of the biggest oil companies in the world report.
Right on cue. Exxon and Chevron both report before the bell today, and the setup is about as favorable as it gets. This quarter had oil topping $100 a barrel for the first time since June of 2022, so the street's modeling the best results in 15 quarters for both names. Exxon's expected around $3.87 a share, more than double last year. Chevron's consensus is $5.81, up over 200% year over year, on revenue near $57.5 billion.
Those are genuinely enormous comps.
They are, and that's exactly what I'd be careful of. A number that big is priced in already. The tell today isn't the headline beat, it's whether management talks about sustaining these margins into a quarter where oil's already given back $10 from the highs, or whether they're cautious about the back half. I'd sat through enough of these calls to know the guidance language matters more than the print when the comp is this favorable.
Anything else on the call worth listening for besides the headline number?
Watch how much airtime Chevron gives its Venezuela assets. That's been a slow burn story. Analysts keep flagging in previews. Any change in how much production they're counting on from there changes the whole back half output picture, and it's the kind of line that gets buried in a call this earnings heavy unless someone on the call actually asks about it.
That's a good one to flag. It's exactly the sort of detail that doesn't move the stock in the first 10 minutes, but matters a lot more by the next quarter.
Give me a level, not a vibe, from you too, since that's become the rule of the show.
Fair. Exxon and Chevron both holding their full-year capital spending guidance unchanged on today's call. That's the number. If either one trims CapEx guidance even slightly while touting a beat this size, that's management quietly telling you they don't believe $87 oil sticks. Confidence in guidance language, not the EPS beat, is the real signal today.
Noted. Exxon and Chevron CapEx guidance, $90 Brent, tariff exemptions inside 30 days, and core inflation data in 6 to 8 weeks. 4 different clocks on 4 different stories, all ticking off the same morning. Let's do the rest of today's setup quickly, because there's more.
The Bank of Japan held its rate at 1% overnight, 8-1, with one hawkish dissent from board member Hajime Takata arguing for a hike. They actually trimmed their own fiscal 2026 inflation forecast to 2.5% from 2.8%.
And the yen's still sitting near a 40-year low even with that dissent on the board, which tells you the market doesn't think one hawkish vote changes the BOJ's trajectory much. That matters for anyone watching the carry trade. A persistently weak yen keeps funding cheap for leveraged bets funneling back into U.S. assets, which has been a quiet tailwind under this whole tech rally most people aren't pricing.
Translate carry trade in one sentence for somebody who's never heard it.
Investors borrow in a currency with a near-zero rate, like the yen, and put that money into higher-returning assets elsewhere. It's basically borrowing cheap to buy expensive, and it works great until the cheap currency stops being cheap.
And on the data side,
Final University of Michigan consumer sentiment lands at 10 Eastern. The preliminary read in mid-July came in at 54.4, up nearly 10% from June on easing gas prices. Worth watching whether that holds given oil's whipsawed since that survey was taken.
54 sounds low in a vacuum. Put it in context for someone who doesn't track this number monthly.
It is low by historical standards. Anything under 70 has usually meant a genuinely nervous consumer over the life of this survey. The improvement matters more than the absolute level right now. It's the direction off a rough spring that the market's actually pricing.
And it's exactly the kind of number that gets reread the second this morning's oil and tariff headlines filter down to a gas pump and a grocery receipt. A survey taken 2 weeks ago doesn't know about today's 60-country tariff list yet.
All right, before we close it out, one non-market minute because it's been a heavy week. Sarah, first full week back in the chair. How's the Rigside 10 holding up in a studio?
Fading fast. Give me a month behind a microphone and I go full vampire.
The most honest thing said on this show in a week.
I point out the rest of us have been trading a market this volatile for 5 straight days, so nobody's looking especially sun-kissed right now either.
Fair point. Back to it. Let's get to closing calls because we've got 3 checkable ones today instead of the usual 2. Marcus, you're on a 2-game win streak. Don't get comfortable.
Wouldn't dream of it. Mine's the tariff clock. If any of the 60 countries on today's list gets an exemption or a rollback announced within the next 30 days, that's the leverage play pattern holding, and I'm right that the market's shrugging this off correctly. Checkable by early September.
Lenore?
Mine's Exxon and Chevron's calls today. If either one trims full-year CapEx guidance even slightly despite beating this big, that's the tell that management doesn't trust $87 oil to hold, and I think at least one of them does it. Checkable by end of day.
Sarah, your first call in this chair since you got here. Make it count.
Brent under $90 due next Friday. If Hormuz tanker traffic keeps recovering the way it has the last 2 days, this de-escalation holds and oil drifts, not spikes, into next week. If we're back above 90 on fresh strikes, I'm wrong and you can hold me to 0 and 2.
3 calls, 3 different clocks, 1 week to find out. So here's today in one breath. Amazon up 12%, Apple down 7% on opposite sides of the same AI supply chain. Chips ripping for a second day inside their worst month since 2002. A fresh 60-country tariff wave landing the same morning as a hawkish Fed's still digesting. Oil easing off the highs as Hormuz traffic recovers. And Exxon and Chevron about to tell us whether they believe their own best quarter in 15. Watch Bren. Watch the tariff list. Watch core inflation over the next 2 prints. If the show's useful to you, follow Nova Ventures Daily wherever you get your podcasts and find our written notes at novaventures.us. That's your Friday morning brief. Have a great weekend, and we'll see you next time.